Hey everyone, welcome to this brand new video here on the Gap Advisors Ind AS Clinic YouTube channel. I am so glad you're joining me today. In this explainer, we're totally putting on our detective hats. We're going to dive deep into the fascinating and sometimes tricky world of financial reporting to uncover how seemingly minor presentation choices can actually completely obscure a company's true financial health. Right, let's get right into it. Everything in today's explainer is drawn straight from the insights in the 230th edition of the Gape Advisors Ask Weekly newsletter. It's authored by C.A. Manish C. Iyer, the director at Gape Advisors, and it was recently published over on LinkedIn. And hey, I really have to mention the Gape Advisors issue repository at gapeadvisors.com. It is literally a goldmine. Anyone can register for free and get instant access to over 4,500 issues and detailed responses on Ind AS and Indian GAAP. Plus, you can submit unlimited issues of your own on Ind AS and Indian GAAP, and you'll get a detailed response delivered directly to the inbox of the email you registered with at gapeadvisors.com. It's an absolutely fantastic resource. Okay, just a quick bit of housekeeping before we jump into the technical stuff. The views expressed in this explainer are the personal views of the author, and, they aren't binding on the audience. Financial reporting definitely requires careful judgment, so please always seek the help of an expert before taking or refraining from taking any action based on what we discussed today.
All right, with that out of the way, I want to kick things off with a pretty fundamental question for you. Are hidden non-cash transactions obscuring your financial statements? It's so easy to just assume that if a balance sheet balances, everything is perfectly fine and transparent. But as we're going to see in just a minute, the way data gets aggregated and classified can actually hide some massive realities about a company's actual cash flow.
So here's our game plan for today's explainer. We've just done our welcome. Next, we'll break down the operating cycle concept, compare current versus non-current rules, and dive into a real-world cash flow mystery. After that, we'll look at accrual versus cash anomalies and wrap up with how to actually enhance financial reporting.
Section 1. Welcome to Gap Advisors.
Section 2. The operating cycle concept. Let's look at Ind AS 1, specifically paragraph 68. This really sets the ground rules. It explicitly defines the operating cycle as the time between acquiring assets for processing and actually realizing them in cash or cash equivalents. Now, what if you can't clearly identify this cycle for a particular business? Well, the standard says you just have to assume it's 12 months. This definition is absolutely crucial. It's the anchor for figuring out what's a current asset or liability and what's not.
Section 3. Current versus non-current rules.
Now, I want you to look really closely at this wording. There is a massive difference between an asset being realized in the normal operating cycle versus within 12 months. According to paragraph 66A and 69A of Ind AS 1, trade receivables and payables that are part of the normal operating cycle are classified as current. And get this, that's true even if they are due to be settled more than 12 months after the reporting period. As long as they're in that cycle, they're current. Some local guidance out there has mistakenly swapped the word in with within, and let me tell you, that leads to tremendous confusion. But the standard is crystal clear here. If it's in the operating cycle, it's current. That gives us a much truer view of a company's working capital.
Section 4. The cash flow mystery. Okay, it's time to put our detective hats on, because this perfectly sets up our puzzle. What we're looking at here is an extract from an actual company's cash flow statement, specifically the operating activities section. Take a look at that bottom line item. See that adjustment for interest income? The company has deducted just over 8.6 million Indian rupees from its net profit before tax. All right, nothing crazy so far, right? Just standard procedure, backing out interest income from operating activities.
But let's check out the next piece of evidence. This is the investing activities extract from that exact same cash flow statement. Right down to the bottom, there's a line for interest received. And look at the amount. It's exactly the same, 8.6 million Indian rupees. So essentially, the company is telling us that the exact amount of interest income accrued for the entire year was also the exact amount of cash they actually received.
But hold on a second. Here's the balance sheet extract showing other financial assets. Focus in on that interest receivable line. In the comparative year, it was sitting at about 4.1 million Indian rupees, but jumped to the current year and it has skyrocketed to roughly 5.7 million Indian rupees. So the interest receivable balance has gone up significantly.
Section 5. Accrual versus cash anomalies.
Okay, so the absolute crux of this whole thing revolves around this exact number, roughly 8.6 million Indian rupees.
The company reported this identical figure for both the interest income they supposedly earned during the year and the actual cash interest they claim to have received during the year.
Which naturally brings us to the logical question that completely blows this financial statement wide open. Think about it. If your interest receivable asset increased by over 1.5 million Indian rupees during the year, which literally means you recognized way more income than you actually collected in cash, how on earth can your cash received perfectly match your total interest income? It's mathematically impossible. There is no way around it. That cash flow statement has a major material error.
And here is the exact rule they broke to create this whole mess. It's straight out of Ind AS 7, paragraph 43. It says that investing and financing transactions that do not require the use of cash or cash equivalents shall be excluded from a statement of cash flows. Because this company clearly didn't receive all that interest in cash. I mean, we know that for a fact because the receivables shot up. They improperly included non-cash investing transactions in their cash flows. Basically, they just took an accrual number and pasted it into their cash flow statement as if actual cash hit their bank account. Crazy, right?
Section 6. Enhancing Financial Reporting.
Now, Ind AS 1 is extremely strict about not obscuring information. And what does that mean? Well, information is considered obscured if it's communicated in a way that basically has the same effect as just leaving it out entirely. In our little case study, this company didn't just mess up their cash flows. They also inappropriately aggregated interest receivable with other financial assets in their notes. Because of this sloppy aggregation, the carrying amount of the financial asset that the interest relates to doesn't actually show its true amortized cost. By squishing these dissimilar items together, they failed to comply with both Ind AS 1 and Ind AS 109. And the end result of all this, none of the components of these financial statements actually present a true and fair view.
So, I want to leave you with this final provocative thought. Are the financial statements you're reviewing actually presenting a genuinely true and fair view? Or are they relying on inappropriate aggregations to hide the reality of non-cash transactions? Remember, financial reporting should be an art of truth, not a practice of obscuration. Well, thank you so much for your time today and for coming along on this deep dive with me. If you found this explainer valuable, please go ahead and hit that like button, add your comments on the video down below, and definitely make sure to subscribe to the Gap Advisors Ind AS Clinic channel if you haven't already subscribed. We've got plenty more investigations into the complex world of financial reporting coming your way soon. Until next time, stay curious and keep learning.